Hey guys, Ben Ficker, multifamily broker with KW Commercial. Thank you so much for joining us for the webinar. I'm sorry to report that we forgot to hit record when Mike Popno was discussing investor financing for residential deals, the 2 to 4 unit stuff. Thank you so much for watching, and on to the webinar.
If you could just repeat the entire thing for us. No, I'm
I'm sure I could do it better, but
I appreciate that. No, we will definitely have you jump back into some of that stuff again in the future. Some of the stuff you touched on, we're seeing it really support. I'm going to get into the numbers on the 2 to 4 unit or 2 to 8 unit stuff later today, but a lot of this smaller plex stuff is being propped up by those owner occupant buyers. They don't care about the return on investment nearly the way that almost everybody on this webinar would. When you bought that duplex, and you bought that 4 unit, and you bought that 20 unit, you were looking at what your returns were going to be. And our market is such that a first-time home buyer is looking to spend $500,000 to $600,000 at a 6.5% interest rate or whatever it is. Now, if they can get that duplex for $7 or $750, and one side is rented out for $2,000 a month, I mean, that plus they got that rate buy down. That is what's keeping these prices on these smaller stuff. It's one aspect of what's keeping these smaller unit count buildings prices up. So it's anyway, thank you so much for sharing that. We've got some stuff going right now with some owner occ stuff that is none of the investors wanted to touch it, but the owner occs were super excited to start their investment portfolio by occupying a duplex or a triplex. But so again, thank you so much for your info there. Kyle, Dan, you guys want to jump in and tell us? Oh, Mike, I know you got some dinner plans. If you want to take off, feel free to take off. No one's judging you for it. They're all judging me for not recording it. So we're good.
Thank you very much.
Thanks, Mike. I appreciate it. Dan and Kyle, if you guys want to jump in, I'm gonna make Kyle a host so that he can share his slides.
And Ben, while you're doing that, how tease up the handful of slides we've got about the rental market, I think one of the takeaways that we should think about as investors that Michael mentioned, and that's household formation. If you can't afford to buy a home to live in, you have to rent a home to live in. And I really, as a rental property owner, I'm seeing really pretty decent rent increases during turnovers from people who are trading down to something less expensive than they're currently in because household budgets have been stretched so thin, if that makes sense. But just because interest rates are high and household formation has slowed down, inventory, all the things that Michael talked about, over the next, I'd call it 12 to 24 months, I see real opportunity as an investor to position my portfolio in such a way that values are going to be pretty robust when interest rates do start to come down. And if you can get a cap rate, if you can get your rents up and get your cap rates aligned, you are really going to be positioned well. The stuff that Michael talked about, there's real opportunity in that. Outside of just the whole buying and selling, which is super important, and that's what we're here to talk about. But this game is a patience game. And think about that household formation number and what it might mean to your portfolio. I certainly am. Some of the inventory that I'm starting to work on myself personally.
I love that you touched on that. For whatever reason, I skipped over this in my introduction. The purpose of this webinar today specifically is we are seeing so many headlines about markets crashing and office buildings going down. And what does this mean for, there's the guy in Texas who gave back 3,300 units because he had an interest rate that went from 4 to 8.5% in a 6-month period. And people are worried about the coming debt scenario on the commercial side. And we'll touch on that stuff a bit. But no matter what the market is doing, the big takeaway for everybody here is no matter what the market is doing, there is an opportunity. If you are looking to purchase properties, there's opportunities. I just got off the phone with a guy who told me about this portfolio. He's closing on next Wednesday. That is blown away at what they're able to get this thing out. So there is opportunity there. If you're looking to sell, we'll talk about the opportunities there and why this could be the time if that's where you're at. And if you're looking to hold long term, there's some opportunities right now either in your expenses or in your current rents that you're getting, there's opportunities to add hundreds of thousands of dollars in value to your property by getting efficient, talking to experts like Michael or Dan or myself about where are in your paper, right? On the back end, where can you move numbers around that literally add hundreds of thousands of dollars to your portfolio? Now is the time to take advantage of those opportunities. But anyway, that's enough for me. Heil, Dan, why don't you guys just jump on in?
Yeah, I'll introduce Hal. Hal's going to take you through real property management solutions data. He is an absolute expert. I got to tell you, he does 2 to 4 underwriting analysis on multifamily every single week. If you want to know what the market's doing, certainly from a real estate standpoint, Ben is absolutely the go-to expert for sure. But Hal spends quite a bit of his time underwriting properties and talking to brokers and investors. He's got his pulse on it big time. And if you're out there wondering what your property should be doing, if it's not doing what you think it should be doing, Hal is a really good person to sit down with. And so he's got a handful of slides he'll take you through, and I'll stop talking and hand it over to him.
Thanks, Dan. Thank you so much for the introduction, Ben and Dan. Today, I'm prepared to go through rental trends and talking a little bit about vacancy and how that's impacting what we're seeing in the rental market locally and nationally. I'm also going to talk briefly about what happened in the legislative aspect, particularly around 2 bills that the state of Oregon passed that are increasing the pressure on landlords. And it's just really important information to have your finger on the pulse of. At the end, I will post a link to my calendar, and I encourage, if you have questions or want to get more in depth, please feel free to set some time there. And I'd love to get to know you and learn a little bit more about your business and how I can help. Quick disclaimer, investments have risk. I'm not an attorney or an accountant. This is advice, and I just ask that you take it as such and speak with an attorney if you feel like you need to. I'm certainly not going to be that person, nor is Dan, but we can certainly give you great advice around property management and steer you in the right direction. Okay, let's jump right into it. Now, after a fall into winter that saw month over month decreases in our local market and off and on a national level, we saw no growth in June, but we saw no real regression either. Rent in Portland matched the national trends, which means that we saw zero growth, holding tight. Year over year growth now stands at just under -2%, down from an increase of 7.5% last year, which gives us put a lot of money in folks' pockets who are paying attention to the rest of the rental market. But if we expand our view around the greater Portland metro area, we'll see that Portland pricing is actually about 10.5% lower than the metro as a whole. And I want to touch on that a little bit as we move into the next slide. Currently, as we look at Portland on a national level, we're seeing that it's the 55th most expensive city in the US. And as I mentioned, a median rent across all unit types of $1,386, which positions it right in line with the national average. We're only about 1.2% higher than national. And this presses us right in line with cities like Fort Worth, suburb of Dallas, and currently means that I believe we have a lot of opportunity from a national perspective, just based on where we are with rents. We certainly haven't seen the kind of rapid growth that might make you feel like you're going to see a little bit of a regression. And we'll talk a little bit about that regression as we move forward. This is kind of a split slide. I'd like to first talk a little bit about that scary word, regression. The fact is, it's not as scary as you might think. In the 4 microclimates or metro areas outside of Portland that saw the largest rental increases, particularly Beaverton, Hillsborough, Tualatin, and Wilsonville, who all saw a total increase in the post 12 to 18 months out of the pandemic of nearly anywhere from 18 to 27%. We're starting to see we're seeing that those come down a little bit. And that's likely as we would all expect. That kind of meteoric rise is likely to see a little bit of market correction as other economic factors change and we see some inflation. And as I point out, these particular markets, we're seeing annual growth of around -5% on average, but that doesn't mean that we're seeing that across all unit types. And I would encourage you, if you have a rental market, if you have a rental property or are looking at investing in particular properties, please reach out to us, because the vacancy rates and the per square foot price based on unit types does change a bit, and it's something that we could discuss outside of this meeting. Now, what's influencing this rent stagnation? Certainly we have to look at the supply side. As Michael alluded to, we're not unlike a lot of other businesses. When there's a lot of supply and demand cools, you see a slight regression in pricing. And our national vacancy index now stands at 7.2%. This matches the peak vacancy rate that we measured at the height of the COVID-19 pandemic. And with more multifamily units under construction than we've ever seen since 1970, more than I've ever seen, might be aging myself down a little there, we're not likely to see that vacancy rate ease dramatically. And while rates locally doubled since the fall, we remain significantly lower than the national level of 7.2%. And I'd like to just show within the neighborhoods of our local metro area what that might look like. Certainly downtown Portland and Northwest Portland are either above or at that average. But you look at markets like Milwaukee, Aloha, Beaverton, and even Gresham, and areas with real opportunity, just barely over half what the national vacancy rate is. And with single family homes still being duplexes, small multiplexes being in high demand, particularly around in the rental market, you can see that there's some opportunity still in our metro area, even if you decide not to buy or invest in downtown Portland. My final slide is a little bit more of slightly sobering, but still gives us room for encouragement. So we saw the pressure on landlords increase in this most recent legislative session. I'd like to start by talking briefly about House Bill 2001. The big takeaway here is the state is really trying to get folks to apply and use a lot of the rental aid that has been made available. And as a result, they've drawn the timeline out a little bit to give renters an opportunity to take advantage of this funding. So the big takeaway for 2001, notice requirements have changed. There's particular disclosure requirements when giving a notice to end the tenancy for non-payment. And you have to delay the FED, first appearance, by at least 15 days when delivering that notice. And while I don't have the time to get into all of the super details around that, I'd be more than happy to. Again, I'll put a link to my calendar. But the big takeaway is there's significant both documentation-based and process-based changes in how landlords are required to end the tenancy for non-payment of rent. Senate Bill 611 really caps rents, and it could have been much more potentially destructive to the investment landscape. However, we did see some pushback. The annual rent cap is going to be capped at 10% or CPI plus 7%, but 10 is the highest it could ever be. But a couple parts of this bill were taken out involving relocation payment and new construction exemptions. But I look forward to getting deeper into those in our future webinar.
Yeah, quick note on that. Everybody who's here today, we're going to send out a link when we send out the replay to join us. We're going to have a discussion next week, probably midday towards the end of the week, diving into the details of that. And just know that what was passed is way better than what it could have been. I know no one's excited about new rent control laws, but could have been worse. Patrick's here. Hi, Patrick. How are you? Heil, Dan, give us something optimistic to think about. What's the takeaway for those who are holding in Portland? What are you've got properties here in Portland. You're still holding? What's going on there?
Yeah, listen, a couple things. One, I really appreciate the information Hal shared. The reason we added that slide around Portland affordability at 55 out of the top 100 cities in the US is this. Portland remains one of the most affordable cities of its size. It's absolutely one of the most affordable cities on the West Coast. Now, we don't get that in the press, but that's a fact. And when you look at apartment list migration report, almost 2/3 of the people who are looking to move want to stay in the Portland area. The top 3 searched from places, the people that are searching to move to Portland, where are they searching from? Take a guess. Seattle, San Francisco, and LA. So we really are positioned well for folks that want to stay on the West Coast. I think we are positioned incredibly well. The other thing to remember is this. Multifamily construction is at a 55-year high. We have delivered a ton of multifamily units over the last few years, but what units have we delivered? Vacancy rates for studio apartments is somewhere around 8 to 10%. Okay. When it comes to vacancy rates, you got to get down to the micro level. When it comes to rent increases, you got to get down to the micro level. Because if you just look at the macro, you're going to miss the opportunity. Okay. So Kyle showed you a chart around Beaverton. I think it was Beaverton, Wilsonville, Hillsborough, Tualatin had mid-single digit rent decreases year to date. Now, if you think about what rents have done since March of 2020, you're in the 25 to 30% range. So you really have to get down to the micro level to look for the opportunity. The final thing I'll tell you is we've lost 6,000 single family rental properties of 3 bedrooms or more in the city of Portland. 6,000. If you've got a property where you can add a bedroom, or you're looking at an investment where you can provide more work from home space, you have yourself a property with big opportunity. In fact, I've got a single family home on North Vancouver Avenue that I was going to tear down and build 4 more units. Long term, that's definitely what I would probably want to do. But for the next 5 years, I'm dressing that single family home up and I'm going to kill it. The kind of return I'm talking about, cash on cash return with how much I need to put into it to what I can get out of it, is around 12%. Just because we are appealing to a demand that is in short supply, and that's units of 3 bedrooms or more. So the headline is, yeah, it's tough, it's soft, but when you start looking at the micro, man, there's some big opportunities out there.
Awesome. Thank you so much, Dan and Heil. Sincerely appreciate it. Heil's link is here in the chat box if you guys want to schedule some time with them. Really, whether you're an expert on your own property management, you're self-managing yourself, or you've got somebody that you love that does stuff, it does not hurt to have a second set of eyes. Take a look at your portfolio and see what's going on, and just see if there's some areas that they can add value, or just point out something, or just tell you everything is going great. I encourage you to take some time and meet with Heil. On that note, we're about to get a little gloomier with Patrick Berry and his wonderful commercial apartment statistics. Patrick and I, we've known each other for a few years, done some deals, working on some deals together. We cover a lot of the same type of topics and what we're going to talk about. So I'm going to let him talk about the apartment side of stuff, and my stuff, when he's done, I'm going to focus on the smaller stuff, info that we pull out of the MLS versus CoStar. Patrick, if you don't know Patrick, let me say this. You need to know Patrick. He runs the Berry Apartment Report. He's probably the most well-known apartment appraiser in our market. Speaks to brokers, speaks to CIM, speaks with Multifamily Northwest. If you've got questions around our market, his apartment report that he puts out that's what everybody waits for. It, they grab it, and then they repurpose it and say, look what Patrick told us. He's the authority on this stuff. Super grateful for our working relationship and our friendship, and I'm really grateful you're here today.
Hey, Ben, well, thank you. I'm going to try and share my screen here.
I'm going to make you co-host right now.
Okay, can you guys see that?
Yes.
Okay, so first of all, thank you for the opportunity. I appreciate the chance to speak with you guys today. I want to cover a number of topics. Usually I do presentations that are maybe 45 minutes to an hour. So I'm going to try and take everything I can and cram all the important stuff in about 10 or 15 minutes here. So I want to start high level, macroeconomic. There's 5 indicators that I consider absolutely essential to the apartment market. Then I want to move into some apartment fundamentals, rents, income, expenses, vacancies, then move into sales and values, which is somewhere some of that doom and gloom comes. And then move on to some forecasts for 2023 and 24. So the first thing I want to look at, there's 5 indicators I consider essential. It's going to be employment, population, home ownership ratio, interest rates, and construction. So despite all the negative news, the doom and gloom on Portland, we currently sit at about 3.6% unemployment, which is wonderful. I'm not sure anyone could ask for anything better. We reached our pre-COVID job levels in August of 2022, and we've continued to grow since that time. This is from the Oregon Office of Economic Analysis, basically the economists for the state of Oregon. They're forecasting that we're going to continue to grow, albeit at a slower pace than previous years. Forecast is growth of less than 1% in the foreseeable future. While this may not seem great, this is a greatly improved forecast over the previous ones from earlier in the year, which actually had us, their baseline forecast called for considerable job losses in 2023 and 2024. We're doing okay on the jobs front. Moving over to population, this is the one that's probably the scariest to me right now. It was well publicized. Oregon was one of about 15 states to lose population in recent years. This is the showing data from 2021 to 2022. We lost about 17,000 people across the state. That was mostly focused in the city of Portland and Multnomah County. So while it's not a great position to be in, we're also not alone in losing population to a lot of high-cost states that lost population. They were flooding towards low-cost states with lower cost of living, a lot of cheaper housing with these work-from-home capabilities. So this is also from the Oregon Office of Economic Analysis. So despite a couple of years of losses, they're pretty rosy. They think that we're going to continue to see that we're going to switch directions and see population growth in the coming years. They're forecasting anywhere between 25 and 30,000 people in 2023, and that will continue to grow at a steady pace from there. Keep in mind that they also called for population growth during 2021 and 2022. So while I'm really hoping for these numbers, these seem pretty optimistic after coming from a loss of population of 17,000 last year. And population growth may not seem essential to everybody, but from the way I look at things, it's absolutely essential. We're currently at a place with our demographics where we have deaths that outnumber births. So the only way that we get any kind of population growth is solely from migration. So it's essential that that Oregon and Portland remain competitive on not only a regional level, but also a national level. It's really the health of the economy and the health of the multifamily industry is dependent upon this population growth. Whether you want more population or don't, it's absolutely essential. So these numbers come out, the measurement goes from July 1st every year to the following year, but the numbers are not published until December. So keep an eye out in December when these numbers come out. And I don't mean to be alarmist here, but this is a quote from Josh Lehner, an economist for the state of Oregon. He calls this loss of population a 2 or 3 alarm fire last year. If 2023 doesn't rebound, it's a 5 alarm fire for the economic outlook. I think when your state economist is saying this, it's a little concerning. So I'm definitely keeping an eye on this and hoping for a rebound in the coming year. I don't have a slide for it, but next thing I look at is home ownership ratio. We're currently holding at about 62%.
Hey,
Given
Patrick,
the for first time.
I just want to ask one quick question.
Yeah.
Do they update this number throughout the year at all, or are they going to tell us whether it's a 5 alarm fire in December versus now?
The data is always delayed. They don't gather it. It's from the American Community Survey, and that is gathered throughout the year, but the data is not published and finalized until December. So expect it just before the
Christmas morning. Yeah,
exactly. More or less. You put this out on December 22nd here.
Yeah, got it. Perfect. Thank you.
Keep an eye out for that. Next thing I look at is home ownership ratio. We currently sit at about 62%. Given the challenges with interest rates and first-time home buyers, I'm not sure we're going to see a drastic increase in home ownership right now. Keep in mind that we have about 900,000 households in Portland Metro. So when we see a 1% change in home ownership ratio, this is 9,000 households that are all of a sudden no longer part of the rental market. We're not necessarily losing them out of the rental market. They weren't always renters, but they're just no longer potential renters. A lot of the increase in vacancies that we saw in 2009, 2010, that was mostly driven by an increase in home ownership ratio. It was not an oversupply It was not population loss. It was simply a shift towards homeownership. So I keep a close eye on this, but I'm not too concerned about it right now. Interest rates. Debt side has a big impact on sales and values. I'll touch on this later. Historically, we've seen about first of all, the rise in interest rates unparalleled. We saw it back in the early 80s was a rise this fast, and values at that time cratered. We've seen a similar rise right now. But the reason I really care about this is the spread that we see between the 10-year treasury and multifamily cap rates. Historically, this spreads anywhere from 150 to 400 basis points, and that's held true for decades. We currently sit at the lowest spread of basically past 30 or 40 years, which tells me that there's plenty of room for cap rates to creep up. I just pulled this today. The 10-year treasury currently sits at 3.95%. So if we assume a spread of 150 to 200 basis points, that's showing cap rates of anywhere from 5.5% to 6%. Cap rates are obviously very delayed compared to an interest rate that can move overnight, but we are seeing cap rates start to trend up, and I expect that to further increase as there is some more room to increase. The last fundamental I look at is apartment construction. We currently have about 9,000 units under construction. Though we are trending down, starts are way down, and this is mainly due to the availability of financing. Also, some demographic changes that just don't make these projects pencil anymore. As you can see, in 2021, we had a lot of delayed jobs that was due to the impact of COVID. These got pushed to 2022, which has led to a surge in completions for this past year. And we have a big pile of completions coming up in the second half of 23 that I'll touch on in just a little bit. So this chart's a bit complicated, but I wouldn't include it unless I thought it was important. The orange lines, the orange bars at the bottom are going to be absorption. The blue bars are going to be deliveries or supply. And then the green is going to be our vacancy rate. And as you can see in the balance of 2023, we have a slew of units coming online, about 8,000 units coming online. And most forecasts are calling for demand somewhere in the range of maybe 3,000 to 3,500 units. So we expect to see a big push up in vacancy rates in this coming year. In the balance of 23 or early 24. After that, supply is going to be much less. And even though we need more units overall, the limited supply in the coming years will benefit some apartment owners, as this will keep vacancies within a reasonable range. But you can see vacancies are forecast to spike in the second half of 2023. Focus on the green line, the 4-star and 5-star, that's brand new units. That includes units in lease up, which can be a little misleading. So if you look at the green line, we currently sit somewhere about maybe 6.8% vacancy rate. We're expected to peak at about 7.2% in the second half of the year, and then trend back towards a stable market somewhere around 6%. But let's be honest, most of us deal in what CoStar considers a 3-star apartment, which always tends to trend about 150 basis points below the market as a whole. So focus on that orange line, I think, is where the vast majority of units are going to fall. So it was previously discussed, but we saw a huge run up in rents following COVID. Anywhere year-over-year rent increases somewhere in the range of 8% for multiple years in a row. That started slowing in the second half of 2022. And moving into 2023, we have seen rents fall in this past quarter. Rents are forecast to continue to fall in the next couple of quarters, just by 1 or 2%. Minimal rent declines. It's happened in the past. It's not a huge deal. After the mid-2024, they expect rents to start increasing again to somewhere in the range of maybe 4% per year. This is a little bit better visual about what's happened for the past 12 months. Basically, we've gone from about $1.96 a square foot to $1.94 per square foot. So it's not the end of the world. This is data taken from CoStar, who also owns apartments.com, and they actually track rents daily on a per square foot basis. I think the big change about this year is we haven't seen the summer boost. Usually we're a cyclical market. We see rents decline in the winter, and then they typically increase in the summer, and they'll push usually above what the declines were. But this year we just haven't seen any kind of summer push at all. And just to give you an idea, bigger picture where we stand, This is rents for the past 5 years, basically gone from $1.65 a square foot to $1.94 a square foot. So up 18% since 2018. So while we're down this year, just a few percentage points, it's not the end of the world. We're still way above where we were 5 years ago. So moving over to sales. To say sales have been slow in 2013 is an understatement. Through the end of June, we've seen 35 total sales across Portland Metro. And this is 5 units and above throughout Multnomah, Washington, Clackamas, and Clark County. Annualized, we're on pace for 70 sales. And so for anyone that doesn't follow sales, the slowdown is it's unprecedented. Last year, we saw 233 sales. 2021, we saw 307 sales. The average since 1990 has been 205 sales. So the only comparison that we can look at is 2009 and 2010. And those years we saw 103, 112 sales. So we're even way below 2008, 2009, 2010. I do expect it to pick up in the second half of 2023, but it's really going to be tough to make up for 35 sales in the first half of the year. There's a number of reasons for this lack of sales. We've seen, obviously, there's been a rise in interest rates, greater economic uncertainty as a whole, which tends to freeze buyers and sellers. We have a continuing challenges with livability throughout the urban area, we're all well aware of. Some destabilization in the banking sector. I think just this week, it was announced that Umpqua is sunsetting their multifamily lending program. And they've been by far one of the biggest lenders in Portland Metro for multifamily for the past decade. We also have buyers and sellers that are just unable to agree on where the market is right now. A lot of sellers are looking at 2022 values and pointing to those sales and saying, I want that per unit price. And you have buyers that are coming with real numbers, real interest rates, and saying, I just can't make this pencil. And they just can't agree on price. And at the same time, you have sellers. There's so little urgency to sell right now. Most owners have a low interest rate. They have stable rents, they have stable vacancies, they have ample equity in their property, unless they bought it in the past maybe 1 or 2 years. And then there's few reasonably priced alternatives. It's not like they can trade easily to a similar product at a property at a price with some upside. So there's just no motivation to sell. I think we're going to see different. It's going to be different in a couple of years when you have when these 3 and 5 year loans are coming due. But as of right now, there's just no urgency to sell. But keep in mind that apartments are not alone. Every single major property type is seeing slowdown somewhere in the range of 60 to 80% this year. So I'd be more concerned if multifamily was the outlier, but it's not. And then also most owners are okay. They just don't feel pressure from operations. Everything's stable right now. And the people who are struggling, though, are the servicers. It's all the people that rely on the transactions from anywhere from appraisers to apartment brokers to mortgage brokers to inspectors to title officers. Those are the people that are really feeling the pain right now. Most owners are just fine. Most property managers are just fine. The income's been pretty stable. So I'm going to jump into values here. And this is the median per unit values. We currently sit at a year-to-date 2023. We're at about $185,000 per unit. This is down 12% from last year. Moving over to per square foot, we sit at $202 per square foot. This is down 18% for last year. But I want everybody to keep in mind, big grain of salt here, that these suggested declines in value, I think it's far overstated. It's a very small sample of sales, only 35 sales that we're looking at here. And no question that there has been some distressed sales. They're not traditional distress. They're not being forced by the bank to sell. They're not foreclosures, but they're properties that owners got sick of and just wanted to get rid of. They had deferred maintenance, maybe some operational challenges, locations with safety concerns, and owners just wanted them off their books. And we're seeing that impact the median price per unit and the price per square foot. A lot of the properties that have retained their value, owners just have no desire to sell right now. So they're not showing up in the per unit and per square foot figures. So again, not all markets are equal. This is actually new units. Ignore the year to date. This is actually through the end of 2022. But you can see properties built since 2010 have basically seen no gain in value. As we move through the years, and in 2016, we were at 261 per unit, and we currently sit at 270,000 per unit. But you move over to suburban counties. This is everything outside of Multnomah County. Prices have basically doubled since 2016. So keep in mind that in 2016, the median per unit price at a suburban unit was 122,000, which is almost identical to where the city of Portland sat at that same time. And currently, median per unit values for 2022 in the city of Portland was about 189,000. So that's a 50% growth. But 25% of that, or half of that growth occurred in the very first year. So if you look just at 2017 to 2022, it's pretty modest gains in value. But in the suburban counties, we were 122, and now they're sitting close to 240,000. So it's been a dramatic shift with investors preferring the suburban counties. I just want to pull a few sales that happened in the past year just to give you an idea of what's selling on the 5 units and above. This is the 53 unit Kenneth Allen, close in Southeast Portland, had major operational challenges. Almost half the units were vacant, a lot of non-paying tenants, major challenges here. It sold for 132,000 a unit back in May. This is a 5 unit property out in Cornelius. It sold for 170,000 in May per unit. Property in Gladstone with incredibly low rents sold for 138,000 per unit back in December. And this is one called El Tiki Apartments in outer Northeast Portland, right on the Max line. Really challenging property. It sold for 132,000 per unit in March of this past year. So this is the CoStar forecast for values. I don't know how they get there, but I know they have multiple economists on their payroll, a lot smarter than me. But they're suggesting that per unit values are down about 8.5%. So not the 12%, not the 18% that was previously discussed, but down about 8.5%. Ignore the raw figures. I focus more on the percent change than the actual raw figures here. So they think we're down about 8.5% currently, and they expect us to decline about another 9% and bottom out in 2024. After that, they expect steady increases, but unfortunately, they think that we won't hit peak 2022 values until at least 2027. Personally, I think that's a little pessimistic, but that's their forecast, and I'm just giving it to you unedited right here. We published our mid-year report recently that did a deep dive into apartment fundamentals throughout Portland Metro, but these were the forecasts we had. We think that the second half of 23 is going to pick up a little bit in sales, but we're going to end the year with fewer than 90 sales over the year. Just tough to overcome 35 in the first half. We think due to limited financing that the pipeline of units under construction will continue to decline. I think values can continue to fall in 23. I'm not sure they're going to fall another 9.5%. I just haven't seen evidence of that yet, but it's a possibility. I think vacancies are going to peak in the second half of the year as we get a surge of apartment completions before they start declining after that. I think this is all based on the assumption that we're going to continue to have some population growth in the years ahead. I think if we continue to see population decline, not only 23, but in 24, I think there's major concerns after that. But this is all predicated on the fact that we're going to have some kind of stabilization in population growth, and we're going to continue to see some increases in the next year or two. Ben, that's what I got. I'm happy to answer any questions, but otherwise I can turn it back over to you.
Awesome, Patrick. I appreciate that. I've got the question and answer box open. So if you have any questions for Patrick, go ahead and throw them in there. I'll jump into my piece here on the 2 to 8 unit stuff. And the difference here is that this is going to be information pulled directly from RMLS. And I would have the caveat that RMLS data can be a lot better in some areas and a lot worse in other areas. So I don't like to look at cap rate in RMLS data because it just it's not usually accurate, right? So there's a few things that we can look at that what I like to look at is the trend more so than anything else. To jump into the apartment stuff real quick, I've had a lot more conversations with apartment owners so far this year than I have had in previous years. And I think most of that revolves around owners seeing the changes legislatively and knowing maybe they've got some notes coming due, maybe not now, maybe in a year, 2 years, and starting to think about this stuff and curious what the market's doing and how all this stuff is going to affect them. And my very anecdotal takeaway is we've had a couple of unicorn years and they want to get those numbers. They look at a cap rate and they want to hit 5.25, whatever it is. They look at price per unit, GRM, they look at all of the regular metrics, and on paper, it all looks good, but none of those deals are selling. And what I've noticed is everything that we're seeing listed for sale on CoStar, so much of it is based off of pro forma numbers, or even if it is based off of real numbers, in order to get financing on it, you've got to be putting 50, 60% down to hit the debt cover ratio with today's interest rates. And most people just aren't willing to do that. And I'm seeing that, again, anecdotally, push into this smaller 2 to 8 unit space. So let's jump into some of those numbers real quick. Sales of 2 to 8 units, 175 year to date. That's down 47.4% over last year. Listings for 2 to 8 units are down 28.1%. And price per units, here we got for duplexes, triplexes, fourplexes, 5 to 8 units. And I like breaking it up that way because it tends to be a different type of buyer. You can see duplex owners, the highest number there. That is propped up, in my opinion, by owner-occupant buyers. They're willing to spend a lot more because they're not concerned about that return on investment as much as an investor. And if you remember what Mike was saying about interest rates, non-owner occupied interest rates are quite a bit higher than those owner occupied interest rates. So if you got an FHA buyer, first time home buyer, they can spend $600 on a starter home, because that's where we're at in Portland, or they can spend $700 on a duplex. Then they can offset their mortgage by $2,000. They're going to do it all day long. Eric, I'm going to jump into your question. I'll ask the question now, and Patrick, if you're still on and want to answer it, great. Eric's asking, can Patrick talk about Dan's comment about looking at the micro level vacancies, and how does a person get that information? Is the city vacancy level good enough, or neighborhood vacancy level? My quick answer, and then Patrick will let you jump in, is we can get into submarket stuff with CoStar data to look at those things. And I know Dan and Patrick have resources to look at other rental information that I don't have, but looking at submarkets and then really looking at the unit mix is important as well. But Patrick, Dan, do you guys want to jump in and speak to that at all?
Yeah, so it definitely matters on the micro vacancy level. I think one of the best resources is Multifamily Northwest. I sit on the apartment report committee, so I can give them a plug right here. But they cover, I know how they do their survey. I know the form they send out to everybody. It's incredibly detailed. It goes into 20 submarkets and then goes by unit type. So they cover about 7 different unit types. I think they're the best source for local data. They have a report published twice a year. I'm happy to send it, or I think it's even on my website. The problem is they only do it twice a year, and some people are looking for more current data. CoStar gets into, you can slice and dice it however you want, but the data is available. The 5 most, in Multifamily Northwest, the 5 most urban submarkets, I think are showing vacancy rates of maybe 5.9%. And the balance of the 15 suburban markets are in the mid-4s. So there's definitely a discrepancy between urban and suburban, but you can definitely get into very detailed data. It's out there if you want it. Oh, yeah, right there.
Read it, absorb it. It doesn't only come out twice a year, but vacancy rates move, but they don't move that fast. Honestly, I pay really close attention to apartment report. The other thing that you can do, there is a couple of rental analysis tools that will project vacancy rates by neighborhood. Rent Range is one of those. It is a little more spendy than Rentometer, but Rent Range will give you a projected vacancy rate. And then I take those 2 things and then I drive around the neighborhood and look for balloons on A-frame signs. I look for lots of rent signs. I look for banners and things like that to talk about concessions. And that's how I get a read for, is this a place I want to put my money?
Am I still muted? I'm not. Good. Dan, you and I were talking earlier today about this. The vacancy rate change and even the rental rate change. It'd be very easy to hear that on the micro level or on the macro level. And then even on the micro level, oh, this zip code or this submarket. But everybody on here, I love you guys, but your rents are probably not anywhere close to the market level that they should be anyway. So you still have room to raise this. Don't let the fear of a vacancy rate and not being able to fill this, don't let that fear keep you from raising your rent from $900 up to the $1,500 that it should be. There's a lot of great owners on here who have their stuff close to market level rents. A lot of the conversations I'm having lately are with owners who think they're close to market level and they're 3 to 4 rent raises away from being there, right? So yes, there could be a higher vacancy rate in that zip code or whatever, but not when someone's getting a $500 discount. They're going to stay there. So all the more reason, talk to somebody like Heil and Dan to get your rents dialed in to know where you should be to set up for the future. Anything to add?
And Ben, I think the other thing too, not to make this go too long, but your vacancy rate is just a snapshot in time. It just tells you what your competitive landscape looks like. That's all it does. And that's not enough to know how to compete. Like, do you know the top 3 changes to what renters want post-pandemic? As somebody who owns rental properties, could you list the top 3 changes in what renters are looking for in a post-pandemic world, and how do your units meet that?
Let me take a stab at this real quick. A place to work from home.
Correct.
They'd like to have a pet, and they'd like to have more storage.
Nope. Air conditioning, in-unit washer and dryer lumped into one.
Got it. Makes sense.
And,
okay. Oh yeah.
And over the last 2 years, I've addressed that, and I got to tell you, the returns are pretty doggone good.
Yeah. Great. Okay. Price per units. This is what we're seeing them do in the MLS. Do I have the real numbers? No, I had that slide twice for some reason. Okay. Price per unit for duplexes. This is only down $1,000 per unit since last year. Triplex price per unit is down 8%. Fourplex is down about 20%. And then 5 to 8 units is really only down $10,000, which is whatever that math is, not a lot, 2.5%, whatever it is. So there is a drop in some of those prices, but the things that are, these are still, no one likes to hear a 20% price drop, but price per unit is still higher than 2021. Price per square foot is still higher than 2022, or price per square unit, price per square foot, advertised GRM, all of those numbers are still higher than 2021. You might not be getting last year's numbers, but again, that was a unicorn year. 2021 was a unicorn year. It's easy to take a look at this, half the sample size that we have over last year, but half the sample size, and draw these major conclusions from it and get panicked or think you missed your opportunity, so you're going to hold on for another 20 years or whatever. And that might be the right move for you. But it's really important to just take this stuff and see how, as Dan talked about, if you're going to hold on to it, how can you take that property you have and add that value with the air conditioning, the washer dryer, add those things so that you're not the statistic of the one who's selling for 20% less than they would have last year. All right, we've got a question. Dan, you've done some development. I'd love your input on this too. Given the tight sales/supply environment, what is your take on buying land and building multifamily housing, 10 to 20 units, instead of buying existing multifamily housing from financial return perspective? And what steps can we take to share the risk of building multifamily housing in time and on budget with the builder to minimize our risk? I would say
that's a webinar in itself.
Yeah, that's we've got 5 seconds to answer this. So no, what I would say is getting land sold, land's not moving like it used to. It is expensive and difficult to build in Portland. We have a bunch of inventory about to hit. I don't have the numbers in front of me, but I would almost bet you anything that the majority of that is studios and 1 bedrooms as well, right? because that's how they can get more units and do that thing. But that's where all the downward pressure on those rents is happening, right? So if you can buy land in Portland and build another set of studios, I don't think that's the maneuver. If you could do it and build fewer units, but 2 bedrooms, maybe. But the reality is, what, a year, 2 years out from having approval to start digging, and how many hundreds of $1,000s in fees to get to, it's difficult to get that stuff done. And I'm not saying don't do it. I'm just saying it's not, if you can buy something at $130 a door and then add 20 grand a door in repair, are you building anything for 150 a door all in? I don't think so. If you're buying below replacement cost, I say that's the maneuver. Dan, Patrick, thoughts?
Yeah, Patrick can close it out, but it comes down to what Patrick said earlier, availability of capital. Honestly, number one, can you find a lender that'll give you a construction loan? That's going to be one of your biggest challenges. I think that's based on the short research I've done. We've seen costs of supplies come down, most notably lumber. I haven't checked lately, but lumber, 1,000 board feet of lumber reached, I think, $1,900 at some point in time during the pandemic. My last development deal, we were hit pretty hard with that, but it's back down to, I think, somewhere around $400, which is good. But now what's happening, we don't have the labor necessary to get things built. So you got capital availability and labor to get it built. And the jobs report that came out today is not helpful, the number of jobs that were created. So one of the deals I'm involved with in South Dakota has not been the cost of material. It's absolutely been labor availability. But I like the idea. I think you can do it. It really all depends on what you buy that land at, honestly. And then you control a ton, obviously, based on your plans around what your cost per construction is going to be. But you're going to spend $250 to $300 a square foot to build that. And then finally, just know that in Portland, Oregon, it takes a while to get this done. It just does. So there's time value money too. But it can be done. And if you do it right, it's pretty profitable.
And
there was one last question. Sorry, Patrick. The one last question around what can you do to hold the builder accountable and deliver on time and budget? Typically, there's some sort of bonus/penalty for finishing on time. So if they finish early, they'll get a bonus. If they finish on time, they get a bonus. If they finish after, they lose some of their profit. But finding a builder who's willing to do that in a world where no shortage of work is actually pretty hard to do.
So my experience comes from just appraising a bunch of these infill multifamily projects. I've probably done 30 over the past 18 months or so. And most of the builders these days I'm seeing are the developer is the general contractor. And they also, by chance, self-perform the framing of the building. There's very few projects getting done today where it's third-party developer, third-party general contractor, everybody's unrelated. A lot of them are all wrapped up into one, and that's how they're making these jobs pencil right now. City of Portland's a challenge, obviously, but I just wanted to note that I've done a few appraisals of infill properties outside City of Portland and Washington and Clackamas County, and they receive incredible demand from buyers. Some of these 10 to 20 unit properties where there's a lot of potential buyers on them, both properties I appraised had 5+ offers for these new stabilized infill type properties, but just not in the city of Portland. One was in Oregon City, another one was in Cornelius, and they both just had incredible demand.
Yeah, hope that answers it. So I want everybody who came to this the title was Capitalizing on Change, right? And if you're here, you either you're looking to own, or you're looking to not own multifamily investment real estate. And there's a few bullet points to take away. If you're holding, you have the opportunity to get those rents where they need to go. You've got an opportunity to get your management in line. You've got the opportunity to get your expenses down. Just a quick story. I've talked to a couple of owners very recently who are looking to sell their property, and they sent over their books. And their books have 2 years of capital expenditures wrapped into maintenance and repairs. which means their expense ratio shows 60% of their gross rents goes to maintenance. Now, the upside is that the buildings doesn't have a lot of work to it because you've done all this stuff. But the way that a lender is going to look at that, they're never going to loan on it. They're never going to get you a loan anywhere close to what you want to get. The standard number right now is 1.25% for a debt cover ratio, meaning your net operating income needs to cover $1.25 for every dollar of principal and interest payments you got to make. So getting that, we're not necessarily backing into values based off of cap rates like we used to, right? Because you can have a 6 cap and lose money because of interest rates today. You could probably have a 6.5 cap and lose interest rates lose money because of interest rates today. Where you need to target is based off of your debt cover ratio. So real numbers, last 3 years of expenses, you're looking at all this stuff. This is how we underwrite deals before we get them over to lenders. You take a look at those expenses, take a look at those incomes. And Caleb, yes, can I repeat that formula? So this is for the debt cover ratio. It's $1.20. So debt cover ratio is net operating income covering your debt service. 1.25 is the ratio that you need to hit, generally speaking, on the banks or with the lenders today.
So basically, Ben, if I'm thinking about it correctly, I will bring in $1.25 in net operating income for every dollar of debt I'm obligated to.
Correct. Yes. Yes. So you got to back into it that way to see if it makes sense for you to sell or not. So for a lot of people, they've got a low 4%, 4.5% interest rate. It may not make sense to sell today, but if they're seeing the legislative changes happening, if they're seeing the small but real migration out of Portland, and you're thinking ahead 2, 3, 4, 5 years, you've got to start that process now to get your stuff in order so that when you go to sell, you've got 3 years of clean books so that you can get the price that you want to get. Does that make sense? The 35 transactions that have happened this year, not a lot to look over. So I happened to look at all of them before this thing. I found one deal in Portland that closed with 35% down. Everything else was 40% down or more. The minimum down on loans is for non-owner occupied, for investment apartment deals, 25%. Nothing in this market for commercial lending that I've seen works at 25% down to hit a debt cover ratio. So you have to work those numbers. On the owner side, if you're going to sell in the future, you have to get yourself prepared today so that you can take it. Because you can't just flip a switch and do it. You can't just give everybody that rent increase notice to double your rents and you're there, right? So you got to get that process started today. So if you're holding, your area of opportunity is to get your expenses in order. Number one, get those books cleaned up. Actually, I think I do have a slide for this one. Hold on. Yeah, clean up your books. You want to separate out those CapEx numbers from your maintenance and repairs numbers. You want as tight of numbers as possible. Realistically, if you own in the 8 to 20, maybe 30 range, professionally managed, you should be around 35, give or take 35% for expense ratio if you're close to stabilized rents. When you're getting higher than that, you're either spending too much on expenses or your rents are too low. On the 2 to 4 unit stuff, we don't worry about that as much, but it does come into play. So you still need to keep an eye on that. Get your rents up, and you need to get your leases in order. This is your opportunity. Clean up your books, get your rents up, and get your leases in order. Especially in the city of Portland, all of the legislative changes we've got some properties potentially coming up down the road. They've got leases from 10 years ago. There's a lot of stuff missing on those leases, right? So the next buyer coming in could potentially be exposed to a lot of risk until they get them on those new leases. So you want to make sure you've got that stuff taken care of. Doing those things, getting those rents up. Actually, I'm going to talk about a deal. I don't have this prepared, so the numbers are going to be estimated. There's a deal right now, sat for a month. I can't believe this thing sat for a month. I missed it, just everybody else missed it. It came on the MLS. Numbers were put in terribly, horrible. They just did not know what they were doing when they put these numbers in. They ran the numbers based on, actually the numbers that they ran with weren't even accurate to what they also showed in the rent roll, right? So when you look at what was on the actual rent roll, you fill the owner occupied unit with what the highest achieved rent at the time was. And then you actually look at the expense. Their expenses included their interest rate. So their NOI was really low. So nothing looked right. It did not like, when you dove into the numbers, it looked really good. And I just did some quick back of the napkin math by bringing everybody up to highest achieved, which would take one round of rent raises, and filling that vacant unit. You're adding something like $150,000 of value based off of a 6 cap. Okay. And then when you bring those highest achieved up to market level rents, which is over the next 2 years of 10% interest raises, you were adding close to a total of, I think it was 270 in value just by pushing paper around. This thing is selling way below where it should. And shame on me for missing it when it hit the deal. I should have called every single one of you, but I missed it. And these are opportunities that are out there in these markets, right? You've got disengaged owners who've owned a long time. They probably ran out of depreciation. They're calling residential brokers who don't know how to run the numbers. They're just plugging in back of the napkin stuff into the spreadsheet and saying, here's what it is. And we're missing the real opportunities. Those opportunities are out there in this market and moving forward, right? Those will be there. If you're holding, don't be that owner who doesn't have anything lined up the right way. If you're buying, get your money lined up. Get those relationships with those residential lenders, if it's 2 to 4 units, or if it's single family, with those commercial lenders, if you're 5 or more units. You need to get your criteria dialed in, and it needs to be realistic to what the market is telling us. You can't come to me and say, hey, anything that's a 10 cap, send it my way, because if I find a real 10 cap, I'll find the money. You need to find what your numbers are so that you can make moves on the deals that make sense to you. And you need to be prepared to write on deals that will add value. Those are going to be the first ones to sell, right? The turnkey within maybe 1 year or one round of rent raises, those are probably going to be the last ones to sell because they're the most stabilized, least deferred maintenance, stuff like that. If you're prepared to add value, there's opportunities coming up. And just to back up real quick, when I say get your criteria dialed in, when you're buying, I'm starting to coin this term around first pass metrics. You need to know average, I'm going to make this up. Average price per unit is, for my product type, is $200 a door. Anything that's priced at $180 a door or less, I'm going to write an offer. Or real numbers, 5.5 cap, I'm going to write an offer. Whatever those quick, easy back of the napkin math calculations you can do, you need to have those dialed in so that you can control the deal and then do a deep dive into the full analysis to really discover where those opportunities are. Had I done that on this deal that I'm thinking of that hasn't closed yet, so I don't want to say anything else about it, this would have been a home run for anybody. On anybody's measurements, it would have been a home run. But you can't dive in and really understand those numbers until you control the deal. Because by the time you do that, another savvy investor swooped in with their offer and picked it up. So you've got to have that kind of stuff figured out before you start writing offers. And these opportunities are coming. Most of my conversations right now are with owners who have bought the last few years. They've got that lower interest rate. The rates are coming up, or they're at 3, 5, 7, 10-year loans tend to be typical in commercial. We see those coming up into this year, into next year. They will need to refinance or sell. If they have not kept their rents up, it's not going to match what their new interest rate is going to be. We're seeing some lenders come out and negotiate extensions on those. So I talked to a guy who was at 4.5. Rate increase was going to put him at 6.65, I think. Talked to the lender. They decided to extend it for another 3 years at, I want to say it was 5.75. Great in today's market, not great to 4.5, but the guy was ecstatic. He's holding on to the building, right? But not everybody's going to do that. And you need to be prepared as a buyer to take advantage of that stuff. If you are a seller coming up if you've got a note coming up, if you've got whatever, if you're considering selling, the question you need to ask yourself, is it going to be harder or easier to be a landlord over the next 3 to 5 years? For some, you're earlier on in your investment career and you are nimble enough to work with the seems like daily changes from the city. Sometimes it's monthly, sometimes it's every, whatever it is. All these changes that come from the city and the state, if you're nimble enough to adjust to those, there's a very optimistic look in the Portland metro area. If you've got, I spoke to a guy a couple of years ago, everything, all of his records were on a yellow notepad piece of paper. If that's you, candidly, you are not prepared for the first lawsuit that's going to come your way, and it will come your way if it hasn't, for not having your stuff exactly how the city of Portland wants it to look for these new rental laws. I'm not here to scare anybody into to sell or to buy. Obviously, that's how I get paid. So clearly, I do have that in the back of my head. But more than anything, I want you to be protected. I want you to protect your asset and maximize your portfolio moving forward. And you can't do that if you're not on top of this stuff, right? So if it's not that way, find professional management, get it that way, and get prepared to, it's going to take some work, right? You can't just turn over 30 years of investment MO and adjust to what the city's having you do now. But I'm here, Dan, Heiler here. We're here to help you guys get your stuff in order. Deferred maintenance, that leaky roof needs to get handled. Those water heaters that are 23 years old, get those handled, right? Get that stuff taken care of so that when the time comes to sell, you are the pretty building, real numbers, best value out there. We are not competing. We're not often comping properties against what has recently sold because there's not a big data set. We're comping it against the competition of what's active out there. Any given day, there's 130, 135 apartments for sale in CoStar. Most of those are pro forma numbers and will not have an offer for the next 6 months unless somebody wins the lottery and decides to blow it on overpriced product. But when you decide to go on the market, that's who our competition is, right? So if their pro forma is 5.5% and your real numbers are 5.5%, your deal is the one selling, right? So you've got to get your rents up, clean up your books, keep an eye on your commercial debt, keep an eye on a lot of owners I'm talking to haven't really thought about the depreciation that has run out or is running out. These things are all important to start crafting that picture so that when the time comes for you to make a change, you are prepared and ready to make that change to maximize your sales price. And the other thing that's come up recently is a lot more conversations around seller carry notes on some of these larger deals. It is tough to carry a note when interest rates are 3% at the bank. When you've got non-owner occupied for a fourplex, I think Mike said it was 7.625. Carrying a note at 6.5% makes it the most enticing deal out there. And 6.5% is not bad money for carrying a note. And when they're bringing 20% down, you almost want them to miss a payment so you can take it back and do it again. So that is another opportunity out there. If you've got questions around that, that's definitely going to be a webinar we're going to be doing here in the future. But there's a lot of opportunities in the exit strategies in our market. And it just makes sense to start getting prepared now to do that stuff. Okay, I got a couple of questions that popped up. Randy says, no question, just a comment. Appreciate the update. On the seller side, the presentation said on the exact reasons why I'm not interested in selling right now. On the buyer side, I've been very frustrated with the lack of inventory offered, which has kept me on the sideline. Absolutely, Randy. I've got properties in Portland that I'm not currently selling, right? But we are keeping them up. Rents are going up. Our leases are in order. Our expenses, we're keeping them in check. So when the time, I've got a great outlook, and it's got a 3.125% interest rate. Why would I sell that? What am I going to exchange that into? It doesn't make sense. For some, it might make sense to sell and move to another market, but you just have to be cognizant of what the real market is doing, not what you want it to be doing. On the buy side, on the sell side, we are in a rare moment in time where the current interest rates, even on the deals that have closed, the 35 that have closed we've closed 35 on the apartment side, and we've seen a total of 97 and 207. So what is that? 304, 2 to 8 units, and then 35, 5 and up units. That's still a lot of transactions that have happened. And those prices aren't reflecting interest rates in the way that they should, especially 2 to 4 units. You've got these guys who would like to buy a 20 unit, would like to buy a 10 unit. Nothing there is penciling. So they're coming in and buying these 5 to 8, or they're buying multiple 4 units because they can come in with more money down and make those deals work, right? The current interest rates are not affecting the value in the way that one would expect. That won't always be the case, right? Buyers will get used to interest rates. Sellers will start to get used to interest rates when their debt's coming up. Then they're going to need to do something, right? On the buy side, it is very frustrating, right? I don't know a lot of buyers who are like, hey, I want a 10% cash on cash return, real numbers going in. I'm not getting those questions. I'm getting people asking for deals that they can finance with 35% down. And there's not a lot of opportunity out there for those deals, or not a lot of product out there available where that actually works. So yeah, it can definitely be frustrating. There is opportunity on off-market deals where we find sellers that are more motivated. They understand that, yeah, they're not getting 2022 numbers, but they're getting 2021 numbers, and it still works for them. Anonymous attendee, they say, with all the legality bills and higher Portland business taxes, is it better to just look at Washington, Clark, and Clackamas County for better investment opportunities compared to Multnomah? I.e., what is attractive features to look for multifamily opportunities in Multnomah compared to the rest of the counties which don't have the baggage? That's a great question. What I would say is, if you think the competition is tough looking for properties today, start looking in Washington County. I should double check this, but last I looked, there was one available in Washington County. One property on the market that, if I remember running the numbers, because it was a few months ago, it was something like 55% down to hit a debt cover ratio. The competition out there is fierce. A lot of people have that same mentality when looking outside of Portland. And by all means, rent's going up outside of Portland, right? Like, these guys know it, that rents are going up in Hillsborough, Beaverton. Go ahead, Kyle, if you want to jump in. Dan, want to jump in?
Ben, just a couple things. Number one, outside of taxes, now certainly taxes, the county matters, but when it comes to rules and ordinances and things like that, don't stress about the county. It really rarely matters. It's state level. In this state, it's the state level or it's the city. So don't get confused about rules and regulations by county. That's more by city. I operate in Portland. I don't worry about any of that stuff because honestly, people are going to live in Portland, and doing everything that Ben said around rents and expenses, et cetera, is super important, because then you keep your margins whole. The one thing we need to worry about, if I get asked, what's the number one thing you're worried about? It's what Patrick said around population growth.
I know a lot of the attendees today have been on numerous webinars with us before. Dan, how many times have you and I talked on these webinars about Portland is a great opportunity as long as people keep moving here. Area is too expensive. Seattle's too expensive. We are the cheapest on the West Coast. People keep moving here. We are now 2 years in a row of declining population growth. I don't think that's going to be the long-term thing. I'm sure Portland still has a lot of great reasons to live here. Things are starting to get cleaned up within the city of Portland, and it just feels better walking around downtown than it used to. But do I see that rebounding in the next year? No. 2 years?
No. Maybe.
I don't know what would drive that. If you can still go an hour, 2 hour plane flight away and keep your $100,000 a year work from home salary, and now you're at a place where you're paying $1,000 to own a property, why would you move back into Portland?
My concern is between City, Portland, and Multnomah County, we've got ourselves put in a tax position where we're the second most expensive city outside of New York. And when those taxpayers start to leave or continue to leave, It's not like we can go raise taxes more. What happens is we're starting to lose infrastructure support, et cetera, and we lose some of the momentum that we've got going on with cleaning the city up. But if you want to really put some pressure on stuff, put pressure on that city council to keep the pressure on getting the city cleaned up. Because if we start losing residents, the residents that we're losing are the people that pay taxes, and that's a problem.
I just realized it is 6:37. We went long. That was incredible. If there are any other questions, by all means, shoot me an email, shoot me a text, reach out to Dan, reach out to Heil, reach out to I'll give you everyone's contact info. However you need to get a hold of people is going to be in the email that I send with this replay. But we're all super happy to answer stuff for you. Patrick, are you still on? Do you have anything? Looks like you took off. Dan, Heil, anything else you guys want to throw in?
To echo what Dan said earlier, there are still a lot of opportunities out there, particularly around unit configuration and vacancy within microclimates. And I just encourage, this is obviously a well-informed group if you're here with Ben, but do your research, because there's still, like Dan said, there's still great opportunity here, even if it's not obvious.
Absolutely. Absolutely. My final thoughts are the same as they are every webinar. We are here to provide as much value to you as owners and investors as we possibly can. All we ask for in return is when the time comes to discuss your next steps, to discuss making a change to professional management, to discuss a change to your portfolio through buying or selling. We're not expecting the deal. We just want an opportunity to sit in front of you and give you our 2 cents. So we appreciate you guys showing up to this stuff. If there's any other value type information you want from us, let us know. We are happy to share. We're happy to give. And it looks like we've been having some audio issues. I'm so sorry about that, everybody. There will be a local recording on my computer of this, so the replay should have better audio. I'm sorry if that was an issue for anyone else, but thank you guys so much. Till next time. Next week, we're going to be doing a deep dive into the 2 legislative House Bill 2001 and then Senate Bill 611. You guys will get a link. You can join us for that discussion, and I hope to see you guys then. Anything else?
Even if you have your portfolio is professionally managed, join that discussion around House Bill 2001 for sure.
Yes,
and Senate
absolutely.
Bill 611, because how you give your property manager direction will be influenced by that.
Absolutely. Anyway, thank you so much, everybody. I appreciate it. Until next time, we'll talk soon. Thanks, guys.